Okay, so I wanted to start this week's weekly economic and market update, and it's really this whole week had to do with Apple because there wasn't any significant news out of uh, from an economic standpoint that really could have moved the markets. And so I want to start with looking at Apple, and then we'll go into the rest of the markets. Um, this is a weekly chart. Now, you remember we had this long run up lasting, 20 plus weeks, where it just was in this channel. And then we had the break of the channel, and then it dropped. We bottomed out, and then started to make our way back up. We were making pretty good progress, and then obviously, what happened on Thursday, looking at the daily, we had a gap down on Thursday because China basically is not allowing any of their political folks to have Apple iPhones in China. And so this gap here was about $200 billion, and the loss from a not from a income statement standpoint, but from a market cap standpoint. So one day on that particular news, and you could we kind of bottomed out. Then on Thursday, Friday, tried to make a little bit of a comeback. You get the sense that maybe it will. Apple's volume has been dropping throughout here, and then you look at the momentum. Obviously, on the daily, you have a big gap. The red is the are the sellers, and the green are the buyers, and the gap between them is relatively large at the moment. And but if you go back to the weekly, you can see that there was a lot of momentum still from when Apple was moving up that channel, and then it dropped down and still hanging in there just because it had such a significant momentum prior to all of this news and breaking the channel and everything else. So, you know, it was really a tale of, especially late in the week, of Apple's fall. The whole week was just kind of a negative week. I'll take a look at that here and the other markets here in just a second. But, if you look at the weekly, we're starting to make a recovery. Thought we'd fill the gap up here, didn't actually wound up creating another gap on the daily on the way back down from that drop Thursday. And then, Friday, just trying to recover, but 62-cent gain. Didn't even fill the gap up here that was left from Wednesday to Thursday. So now the upcoming week, supposedly Apple has some, they have their conference basically where they're going to announce their new products and those types of things. That usually gives them a pop, at least in the short term, especially if they've got some neat things coming out. And supposedly they do. And so we'll see what happens there with regards to Apple and its recovery. And, the reason I'm even spending so much time on talking about Apple is because, they're in the S&P, they're in, all pretty much every significant ETF that's out there. And so when they fall, the rest of the markets typically will feel it. And that's kind of what you ran into last week. Now, looking at, we'll take a look here at both the markets and the economic calendar coming up, because this is a little bit more important week coming up. It will move not based on an individual stock. The markets will move not based on an individual stock that's important, at least foreseeably. So anything can happen. Apple come up with a bunch of duds for products, for instance, but there could be other things that happen. but the economic calendar is full of pitfalls, and we'll take a look at that here in just a minute. But let's just finish the markets. Again, let's start with the weekly chart, and you can see for the week we were down. We had a nice up move here. We're down this past week, and Apple really drug it down. I mean, that was kind of the stimulus for the markets to move down, and it was almost contagious, from that standpoint. Now on the SPY, again, we look at the weekly. We still have momentum here. Anything above 25, consider having momentum. And then you look at the daily, kind of a mixed picture, but we had kind of a double cross here. The red crossed the green crossed the red. And I want to make note of something, because I was talking to some folks that follow the channel, and they said, oh, we have a hard time seeing your charts. Just make sure your settings on YouTube are, you go to 1080 HD, and you should get a clearer picture of the charts. And I've done a few things to try and make it clearer on my side when I download it, but putting it on there will allow you to see what's happening a little bit better, especially some of these smaller lines. I'm not sure there's much I can do on these lines on the ADX and DI here, but take my word for it. The green just, red crossed green here, green crossed red here. So, but we have a falling ADX, which is just the difference between the two. And, we're still in an uptrend. We could fall some and still be okay. I wouldn't go anywhere lower on the SPY than 433 or so. But I'm hoping it'll bounce from here and go on up and hit new highs. But so that was the SPY, the Qs, more technology heavy. Let me get some of this stuff off of here. We have for the day. This is the daily. You can see the drop from when Apple dropped. Remember, I mean, Apple's in everything. It's a significant percent. So when Apple gets a cold, everybody else gets the flu. So it was tough for the Qs. IWM after last week, where he had some significant. I really thought maybe we'd be off to the races here, but I wouldn't look for anything out of the Russell, which is all the smaller stocks, until we get up over at least here, this 200. Just get rid of all this. Here would be nice, 199 somewhere. I think significantly, you probably got to get up here over 202 for it really to break. It's been in this channel here. It's a pretty broad channel, between 60 and 202. That's a pretty big range. So that's the Russell. We had the 10-year, which I'm going to talk about a little bit later in my final comments when I talk about Peter Schiff versus David Hunter, and what's going to happen with the economy here. At least according to these two significant contrarians, one economically, one on the markets, which would be David Hunter, and economically it would be more Peter Schiff. But we come up to this 4.33%, slipped past it a little bit, kind of came up. We do have a lower high, just barely, from last week. Just look at the weekly here on that, and you can see it tried to make its way back up. It didn't. So this will be a very telling week on the 10-year, especially with CPI and that we'll talk about here in a second, and PPI upcoming. The dollar, gained strength again. We came back down here, and this is a weekly. These are weekly data, But last, basically, other than Monday, Tuesday, or excuse me, there were 4 days this week. So every day this week, the uh, market was, or the dollar, US, the DXY was up, and it's heading towards this zone here, which the expectation is that we will bounce back down below, but we'll have to see, and that'll be the late conversation. There's crude, which we'll talk about again here in just a little bit, and then the VIX still continue to get, as with all the, down side of the markets, all of them, the Dow Jones, the SPY, the Qs, the IWM, the VIX volatility index is still not, getting up over, say, 15, 16 in that area, and 20 is a far shot away, at least for the moment. The breadth of the market continues to fall, which is a little bit troubling. We kind of have this head and shoulders pattern that's going, although I believe some people will say it has to go up, but we're actually below the shoulder on this. We'll see how this all plays out. Does this continue to fall? We need more breadth in the market, and this MMTH is the percent of stocks above the 200-day, which has been falling. Eventually, with Apple Week and some of the FANG stocks kind of treading water, you're going to need to get either some breadth or have those recover in order for this market to really move up. Economic calendar. Starting with earlier this week. So obviously on Monday we had Labor Day. Tuesday, factory orders were down 2.1%. That continues the trend of, kind of downward. It was in the range, basically, of what the expectation was. Mortgage rates backed off a little bit this week, down 0.1%. And then we had the S&P PMI and the ISM. They kind of conflicted a little bit, but probably not a big deal. But the composite, let's take the S&P, which is both services and manufacturing, was at 50.2, and you can see we've been kind of peaked out here at 54.3 and have started to make our way back down, at least on this index. Manufacturing still is weak, and then services is hanging in there, but at 50.5. But if you go back and you look at the ISM, kind of is a little bit more conflicting with that. So the services was up more than expected, and so that we saw a little bit of weakness on the services portion, down 0.5% than expectation. The S&P PMI, and then the ISM service PMI actually had an increase. So they measure things in different ways, but it's somewhat noted. But 2 points over, that to me is okay. We're showing some strength, whereas the other one's showing some weakness. Thursday we had the initial jobless claims came in lower than expected. 234 is expected. 216 is what we got. And what else did we have that's significant here? Well, that pretty much was it for the week. So there really wasn't that much economic news that should have moved the market. But, it just kind of, because of Apple, it moved down. It was influenced by that. Now, next week we really don't have anything until Wednesday, but that really starts things. We obviously will get the obligatory mortgage rate, the new one coming in. We would hopefully start to see that go down. Core inflation rate expected at 0.2%, and then the significant one, the inflation rate year over year, where the previous period was 3.2. Their expectation somewhere between 3.4, 3.6, which is still higher. And I think the market's kind of already got that priced in, although it may react negatively to it anyway if it's in line. And we'll take a look at some of the inflation data that's coming out. We already saw crude is up near highs, with the expectation it may turn. Then Thursday we have the PPI that comes out, and that can be a mover. We could have Wednesday, everybody freaks out because the year-over-year inflation rate maybe comes in, let's say, at 3.7%. I don't know. And then on Thursday, the PPI may come in lighter. We'll just have to see. Although a lot of these things are really run by crude oil and the price, because it plays such a major role in our economy as far as transportation costs and getting to work costs and manufacturing costs and services costs. It really affects quite a bit as far as crude oil goes. And then Friday we have the manufacturing index, which has been coming in weak, the New York manufacturing index, and then we have the Michigan consumer sentiment, which came, it's pretty close to last period, 69.5, but 69.2 expected that it'll continue to tick down. All these things will play, especially CPI, PPI, and the consumer sentiment. If it continues to drop, they can kind of cancel each other out. But let's look at the next couple of weeks. We got the Truflation portion. It's been ticking up slowly back up to 2.68%, where it bottomed at 2.08%. And then we have, from a sentiment standpoint, we have things increasing over the expectations for the next 6 months, and which was kind of a little bit bizarre to me, because I'm not that bullish at this point. As far as the next 6 months, if I look 6 months out, I think we're going to be at least the beginning of some problems. And then the fear and greed index is now neutral after we've been in extreme greed. We're now neutral, and this could really get kicked down if CPI comes in much hotter, or PPI, or both. That could affect things. So that's a look at that. My final comment really is I want to just kind of go back, because I think it's significant. Everybody on the channels, you got, JP Morgan coming out saying, oh, we're going to have a hard landing as far as the economy goes. We've got a lot of the pundits on there that talk about it, whether they're economists or market watchers or hedge fund, are a mixed bag of, it's going to increase, it's going to decrease, those types of things. But, the reason I talk about Peter Schiff and David Hunter is because they are the most extreme, but they've been the most correct when I look back at their record of predicting. Peter Schiff, more on the economic side, has been correct. He's been horribly wrong on the market. And even though David Hunter has a bit better record on the markets, when you go back and look at some of his past calls, and he admittedly says this is a big call at the end of a cycle, a bull cycle like we've been in for the last 40 years or so. And so, when I look at this, go back to the markets here, you're going to talk in terms of the SPY. If you follow David Hunter on Twitter, his expectation this thing still runs. I've talked about this before. Really, to all-time highs, which would be up here around 480.18, I believe was the number. And so, that's saying we're going to go up here and go past it, and then he's calling for probably up to somewhere between 600 on the SPY, which would be equivalent of 6,000 for the S&P, or approximately, and then or 7,000. So that's quite a run. So how are we doing, based on this? Well, the market still gives me hope. And the reason on David Hunter's call, because it really, you look at the monthly, we've come down, we've come back up. We're still kind of in this uptrend here on the monthly. It doesn't have a huge amount of strength. You go to the weekly, and you see a lot more strength still in the weekly data for the S&P. And so from a market perspective, I favor that David Hunter may have an argument. The things that are concerning that may favor Peter Schiff in this is the 10-year yield, which we're out pretty close to the highs here. His expectation, David Hunter's expectation, is this thing will start to go down. Peter Schiff says this is going to continue to go up. And the thing that Peter Schiff expects to drive it, and they are both diametrically opposed to each other as far as their predictions, is Peter Schiff expects this to explode up on crude oil, and David Hunter expects this thing to start to roll over from where it is. Now, it might hit the 92. I listened to Gareth Soloway on he's got some charts that basically say, it could get as high as 90. Then his expectation is to start to roll over. Obviously, the volume has started to increase, since it was way up here at, 120 in that area. But now, we've seen a loss of that particular volume. We'll see if that's enough to carry the day. I don't know what happens from here. Is this a false breakout? Immediately it comes back down, looking at the daily, or does it make its way all the way up to 92 before it starts to roll over, or does it just keep going up? That will be kind of the deciding piece of it. So, those are my final comments on this. I would probably put, as far as looking at the markets and that, you can put your own weight on it. I would say, at the moment, I probably favor Peter Schiff at 60% or so, and David Hunter at 40%, but neither one of them are out of it or in it at this point until we start to see more data and more movement. This week will be very telling. I'd be a little bit more concerned if I was David Hunter looking at the CPI and the PPI coming out this week, that this could, the 10-year would continue to rise, or that, crude oil, they keep cutting back production on that, and Joe Biden keeps, saying don't drill here or don't drill there. Now, it takes a while for drilling to commence once you say, okay, we're going to allow you to drill there. And I think that'll come back to bite us at the end of the decade. But, a lot of David Hunter's portion is that he sees the 10-year rolling over and and start to decrease on the yield, and that crude oil would begin to roll over from where we are, and we're at kind of crucial points. So we'll see, how it plays out. At some point, I think, I may be wrong. To me, if it starts getting beyond 92, starts to make its way up, it's going to be awfully hard for David Hunter's forecast to come true, because that's going to play into inflation. If we start to get CPI and PPI going up, then obviously that's going to play a role. That's going to be negative, and there'll be a lot of pressure on the markets, as we move forward. But still up in the air. I'm just giving you my guess, from listening and kind of looking at some of the things I just talked about. So follow the S&P. Was probably a good barometer. Follow crude oil. Follow the 10-year yield, and that'll kind of tell you how this thing is going to play out. So anyway, that's what I wanted to cover this week. And remember, there is always a better way.